Another day, another time, we are pleased to come to you to share the information relating to accounting. Welcome to Kings and Queens accounting class. Today, we wish to share with you information relating to partnership accounts. And we hope that by the end of this lesson, that all the difficulties that you would have had would be clarified. Ladies and gentlemen, we ask you that if you like this lesson, please click the like button below. And also if this is the first time that you are being a part of this lesson, Kings and Queens accounting class, please click the subscribe button and you will be notified as soon as we upload a new lesson. Another time, I'm very happy to share with you again. And so let's get on with business. Partnership accounting. We have been spending our time looking at accounts relating to the sole trader or the sole proprietor, and the final accounts relating to income statement and balance sheet. In respect of the income statement, the net profit would be what the proprietor or the owner would have earned, and all that profit would have been going straight to the proprietor or the owner. All right, that is the bottom line of his operation, or the income and that he would receive as a result of conducting the business. Now, with partnership accounting, there are more than one person who now forms the ownership of this business, and by regulation, at least 2 to 20 persons on a normal basis, because there are some exceptions, like with banks that has only 10 persons can become partners to a banking institution. Lawyers may have an unlimited number of partners, but on the whole, normally speaking, partnership constitute 2 to 20 persons. And there are a lot of benefits in participating in a partnership. One of which is that you are now sharing skills. The business have access to a wide variety of skills to enhance its operation, assistance in terms of income or capital to the business, and the list goes on in relation to the benefits of a partnership. Now, with a partnership, there is what is referred to. So, by the way, we are going to be looking at these objectives. Want to explain the concepts of partnership, which I've just done. That the partnership is really a business that is done between 2 to 20 persons. And of course, I want to go a little bit deeper to say that some partnership may be a limited partnership or an unlimited partnership, right? Now, a limited partnership is where all the members, where the members can only lose that which they have contributed or are invested in the business in the event that the business become bankrupt. They can only lose that proportion to which they have invested in the business. All right, that if it is a limited liability partnership. If it is an unlimited liability partnership, then what will happen is that the partners, they would lose not just what they have contributed to the business in terms of their investment into the partnership, but other private resources, be it their private cars, house, land, or other possessions, to cover costs to pay their creditors or their debt. All right. it is also understood as well by law that if the partnership is a unlimited partner, if the partnership is a limited partnership, yes, if the arrangement is a limited arrangement, then our limited liability arrangement, then the law requires that at least one partner must be an unlimited partner. So if you have a partner, a set of 20 persons in a partnership, the law says that if 19 of them are limited liability partners, at least one must be an unlimited liability partner. All right, let's go on now to look at partnership deed. The partnership deed really is the contract or the agreement or the arrangement that governs the partnership, right? So people coming together, yes, to operate an institution or a business. The partnership deed is setting out the rules of engagement, And so when we talk about the partnership deed, oh Lord, right? When we talk about the partnership deed, there are some critical clause that I want to make mention of. One has to do with capital. So one of the clause speaks to what level of contribution of capital each partner will be giving to the business, right? So it is capital contribution. 2, the partners also would agree on interest on capital. Interest on capital. Let me just explain quickly. What the concept behind interest on capital is really to reward the partners for taking the risk to invest their money in the business. Right? It's a reward or a benefit or an encouragement, if you would, to the partners for really taking their resources and or monies and invest it and become a part of the business. And the rationale for that, again, would be in the event the individuals would have taken their money or that proportion or the capital that they're putting in the business and they put it into a bank account and leave it there, let us say, for a year, they would get interest on that money that they have placed into a bank account. So they are getting a return, not doing anything, just putting the money there. They would get a return at the end of the year on their money that they are placed in the bank account, right? Now, so the idea is compensating or rewarding, yes, the partners for taking the risk of investing in the partnership. So the interest and joy now is really the benefit. So if they could have put their money into the bank, yes, and got interest on it at the end of the year, the fact that they are putting it into the business, they should be able to get benefit as well. All right, and even better than putting it into the bank. All right. Thirdly, we have what is called interest. So the partners must decide on interest on drawings, right? Interest on drawings. Now, we had established in previous lesson that drawings is really where the owner, right, takes out of the business any asset or cash for their personal or private use. Okay? So if, for example, we're operating a bakery and it's a partnership, okay, and one of the partner decides to take one of the bread to take home for family, right, and he did not pay for it, that would be a join. He's taking it for his private use. So joins is any resource that is taken out of the business by the owner, right, for his or her private use. Now, the concept of interest and join was to more or less limit or put a reduction on the level of withdrawal from the partnership. It is really put this clause is really to kind of put some control, right? Or to reduce the likelihood of them taking too much out of the business. All right, so interest and joins is charged as a means of the amount of money that are amount of money or resources that is taken out of the business. All right, sorry for that. So what we're saying here is that interest and joins is done. It's an income to the partnership, right? It's an income. The word that I was looking for is deterrent. The interest and join will act as a deterrent, yes, to the partners, because it is really reducing the amount of money that they would have in the business, and they are giving back, right? They have to give back. All right, so interest and joins. Now, number 4, the business also will have to establish guidelines in relation to new partners, adding new partners. So let me put it this way: addition of new partner. What are the rules governing the addition of new partners? So they will have to establish that. All right. There's a 5th matter, and it is relation to salaries. Salaries. Now, the partners who take active part in the operation of the partnership are paid. So it is their job. They work. They are owners, but they are working in the business. So they are paid a salary. Now, on the other hand, there may be other partners who, though they are partners of the business, they do not work in the business. And as a result of that, they are referred to as sleeping partners. Right? Sleeping partners or inactive partners. I'll give you an example. So Mark just graduated from college and wants to start his small business, and goes to his father and said, "Daddy, I'd like to start this automotive business." And Daddy said, "All right, we're going to do it in the form of a partnership. I will contribute to the business, so I'll assist you in the investment of the funds, but you will be the one who will run it and manage it." Right? So the father would be the sleeping partner, right? And the son would be an active partner, right? So the son would perhaps collect a salary because he's working in the business. The father would benefit from all the other arrangements, such as interest and capital, etc., and shares of the profit, but the individual remains a sleeping partner. I want to go to the 6th clause, and that is how the partners are going to be shares of profit, how they're going to share their profits or loss. What arrangement rather will they make in sharing of the profit? All right. Now, I want to spend a little time here because there are various arrangements that can be done to calculate the shares of profit. After all the required deductions and allotment to the partners, that which is left out of the net profit will be shared between the partners or among the partners. Now, there is one method that takes place is that they may share the profit using percentage, right? So it may be 60% for one partner if it's two partners, and 40%. So they are sharing profits based on percentage. But there's also the idea of sharing the profit using ratio. So for example, they are sharing the profit 3 to 2, ratio of 3 to 2. And in order to do this, to share the profit, now to work this, you add the sum. You add this sum, which is going to be 5. So for each it will be, for example, 3 over 5, and the other is going to be 2 over 5. All right? And the third idea in sharing the profit is based on the capital, based on the capital ratio. Based on the capital ratio. So if one partner has introduced $10,000 and the other has introduced, let us say, $6,000, right? They will be sharing based on their capital ratio, and what you're going to do is simply to do almost the same thing as the ratio, as this ratio. So you will eliminate what is common among them first, and then so you'll have 10 and 6. So and you're going to add 10 plus 6 is going to be 16. So for one it's going to be 10 over 16, and the other is going to be 6 over 16. All right, and that is how you will use the capital ratio to determine what amount of money they get for profit. So you will find in some questions or some situations where they give you the percentage and you simply work the percentage out of 100, right? Because this would be 60 over 100, and the other would be 40 over 100. If it is ratios, all right, straight ratios, you are going to add the sum of each, right? You're going to add the sum, and then for each of them, it's going to, the sum will be the denominator, and this will be the numerator, right? 3 will be the numerator, 2 will be the numerator, all right, for each of them. Or in the event of capital ratio, right, they say you're going to share the money based on the partner's capital ratio. You're going to use the capital, break it down to small fractions, if you would, and then that will assist you in calculating the ratio or the profits. All right, let's move on. Now, in doing, so we have done that and we have done that one, but I'm going to move on to say there is an account that is open when we are doing the allocating. We're allocating the monies that are due to the partners, referred to as the appropriation. Appropriation account. Some will refer to it as profit and loss appropriation, so they'll have the profit and loss appropriation before it. Okay, now this account is simply used to allocate, and I said it earlier, allocate the profit to the partners. So the purpose of this, of the appropriation account, you're really allocating. Yes, you're sharing up the monies in relation to the total amount of profit, your net profit. Yes, you're going to share it up for them, to them. So that is what the appropriation account is about. All right. Now, let's go to objective 3, and that has to do with fixed capital and fluctuating capital. Once there is fixed capital, and by fixed capital, once the partnership or the business operating using what is referred to as a fixed capital, they are going to be operate also using a current account, right? So every time that you see in any question that the partners, they indicate that the partners operating a fixed capital arrangement, it means that the partnership is also using a current account. Now, a fixed capital, the arrangement of fixed capital is where you enter into the ledgers, into the capital account, the amount that each partner has contributed to the partnership, and there's no significant adjustment. No adjustment is done to it. So it remains, and that's why it's called fixed capital. There's no adjustment every year that is done to the partnership account, to the capital account of each of the partners, right? Only if there is a situation where, for example, the partners some of the partners are introducing more capital, they're putting more capital in the business, then you will find that you're going to be adding or doing any work with the capital account. Or if the partner has taken out anything significant out of the business, right? So the point of the matter is that fixed capital exists by virtue of the fact that, let me just point out. So for example, you open, this is the capital account. Capital account, and it is for Mark, right? And Mark is one of the partners. And so, Mark entered the partnership, let us say 2010, and May 1. And he had introduced the money that he put into the business in the bank. So it is bank. And he placed into the business $70,000. So every year, nothing will be done to this account. Once it is entered into the general ledger, right? Nothing is done to it. There's no adjustment, so it remains fixed. But where the adjustment will be done is through the current account. Now, there are some partnerships who operate what is called a fluctuating capital. In other words, all of the allocation and assignment of the earnings of each of the partners will be adjusted in their account. That's why it's called a fluctuating. It is the balance on the partner's account will change. So in the event, if it is fluctuating, it means that entries are going to be made in the partner's account. Yes? And what will happen is that at the end of the year, it is showing a different balance. That is what is meant by fluctuating. That means the capital account balance will change because you are making instead of making the entries in the current account, you are making the entries in the capital account. So the capital account balance will change every year. All right. Now that we have shared these concepts, I'm going to move on to do something to show you just an example of the appropriation account. So let's get it on. So profit and loss appropriation. Wow. Account, and normally it would be for the year ended. Okay. Now, let me illustrate quickly. So your net profit coming from your income statement, you would use the net profit and say the net profit is $100,000. Let's use a better figure. All right. And the interest and joins, you're going to add it. You will add the interest and joins. Why? Because it is an income. You're charging the partners for taking things out of the business. All right. So benefit coming back to the partnership. So if it is for black, and Brown. Okay, and entry using let's say this is 1,000 and this is 2,000, so the total of this would be 3,000. So you're going to have 103,000. All right, so you add the interest and joint, as I said, because it's money's income coming back to the partnership. You're charging the partners for what they have taken out of the business, charging them an interest. Okay, all right, now the other thing now, so now that we have calculated, this is what we are going to be, this is all the monies that we have for the particular period to share up among the partners. So we're going to subtract our less, let us say now the salaries, all right, and let us say Black is paid a salary, both are paid a salary. So let's say one is paid, right, $10,000, another is paid $5,000. So we're going to see a total of $15,000 here. We're also going to have, subtract now, interest on capital, right? And let's say Black and Brown. So Black is interest on capital is 500. Make it a 2,000. And this is 1,000. So the total here is going to be 3,000. What will happen now is that we're going to add the total salary and the total interest on capital, right? And that will give us 18,000. Right? Now, what the next action will take is that we're going to subtract the 18,000 from the 103,000. Yes? And that is what we're going to share up. So it's going to be $85,000 that we are now going to share. We have, after we have allocated, yes, to the partners their required salary amount, the interest that they would have earned on their capital, we have $85,000, and this $85,000 now we are going to share it among them. So we come to what is referred to as shares of profit for Black and Brown. So so let us say the partners are going to share it, yes, in the ratio. Let us say it is 2 to 1. They're sharing the ratio of 2 to 1. It means that if we're sharing the ratio of 2 to 1, we're going to add this. Yes, 2 plus 1, 3. So it's going to be 2 over 3 and 1 over 3. Okay, that is what is going to be determined. So it's going to be 2/3 and 1/3. Okay, and we'll find 2/3 of this figure and find 1/3 of this figure to determine the shares of profit. So when we find 2/3 of 85,000, we will get 56,667, and 1/3 of 85,000 would be 28,333. If we add this, which we need to get back the same figure to know that we're correct, it should give us, this is 10 and 10 and 10, yes, Get over that. It'll be 5 and 7, 8. Good. So we are correct. Alright, so the business would have shared the profit between them. Alright, and that is the idea of the appropriation account. We will be moving into the second half of this lesson, where we're going to be looking now at the current account, and as well as we're going to be looking at the extract of the balance sheet. How does it look in the balance sheet with partnership account? But firstly, what we want to do in our next lesson is to show you from a structured question how to do the appropriation account, then the current account, and then we'll move to do how we look at the balance sheet extract. All right. Thank you very much for joining us. I hope that you have been helped and that the content is clear, simple, and you are learning. This is Kings and Queens Accounting Class. Thanks again.